All right. Here we go. Here we go. We are live. Hello, everyone. Sound check. Oh, 1 2 1 2. Bunch of you guys in the chat already before we even got started. That's amazing. Definitely the busiest the chat has ever been before we started to stream. I see Eric Martinson has decided to join us before his meetings began. Let's do this. Hello. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. Hello, friends. Good to see everyone. It is Wednesday, my dudes. December 20th, 2023, 11 a.m. in beautiful Austin, Texas. Good to see everybody. Thanks for joining us today. We had a bunch of activity in the chat before my broadcast began. Let me just, before I even start my rambling, let me pause briefly and rewind in the chat. Sick Thinker gifted 5 memberships. Thank you so much, Sick Thinker. Welcome to everyone who has now recently become a member of the chat. Eric Martinson also gifting memberships and becoming one himself. Thank you, brother. Thank you so much. Eric gifted 4 or 5 of them, 6 of them. David gifted another one. David also kicked us off last week, gifting the first memberships on the channel. Thank you to everyone. So just for a reminder for anyone who missed it last week, I enabled channel memberships, which is a YouTube feature that's similar to Twitch subscriptions. Just a way to support the channel if you want to. Completely up to you. Your name changes color. There's a couple of emojis. I'm working on getting some more. We don't have them yet, but it's Christmas. It's kind of tough to pull it all together in a week. So over the next couple weeks, I'll work on getting some more emojis for this. And then after the holiday, we will start doing membership streams. Maybe like, I don't know how often, maybe once a month, maybe twice a month, something like that. Where at least once a month we'll get together, and just to those who are subscribers to or members of the channel who've taken that extra step, we'll just do a private stream for us, but we'll still continue doing these weekly public streams. That won't change at all. So you don't have to feel pressured to become a member, subscriber, or whatever. If you don't want to, that's completely up to you. Thank you very much for showing your support to me. It just goes to me. And so that's what that is. All right, man, it's been a fun week or so just to kind of watch the market, because we're at a really fascinating inflection point, right? We've been watching the cycle really closely, been studying it all year. We have a recession thesis that has not yet been invalidated, and it will be a few more months until it becomes invalidated by positive data. There's no way to invalidate it today. It will require some more time necessarily. So we're kind of in this weird waiting phase, but some of the dynamics we've expected to take place in a late cycle environment are lining up, right? We have, as we've been looking at, we've looked at quite a bit on the channel here. We've been watching labor growth, right? And how it's been slowing down really similarly to past eras, right? If we go look at it here, this black line is following the gray line like perfectly, right? And we know that there are still 1, 2, 3, 4 examples of recessions ahead of where we are today, just based on the historical data set. Right? It doesn't mean that once we get past this line, there's no way a recession happens. And it also doesn't mean that just because we're here and we haven't had one yet, that it means the coast is clear. It means that we're halfway through a distribution that has 1, 2, 3, 4, 5, 6, 7 examples of recessions out of the, dozen and a half that have happened in the last century. These are the ones related to yield curve inversions and how much time has gone by. And we're right in that sweet spot. Like this area right here is what I've deemed it the sweet spot because this is where we have a cluster of these recessions all beginning in a 4-month span, right? We had one, then we had one, then we had one, then a gap, and now we've got all these here. So I've been calling this the sweet spot, and we just got there. And we just got there, and right now we have everyone clamoring to call victory, right? Just look at the behavior of the market. Look at what yields have done since the FOMC, right? Or really just the last few weeks. But since FOMC, they've been coming down sharply. This is the 10-year. Here's the 30-year. Oh, let me get that line off. Here's the 30-year. Here's the 2-year. Look at that drop. When you look at the market itself, soft landing is consensus, right? We have popular economists who are telling everyone that it's time to declare victory and that everyone who was wrong needs to perform a mea culpa and explain why they were wrong and what they got wrong. Claudia Sahm. This person here is a very famous economist. They have a rule that is named after them called the Sahm rule that dictates that once recession has risen 0.5%, the moving average of their rule says that once unemployment, the 3-month average of unemployment rises 0.5% off of the yearly low, that means we're in a recession. That's happened every time we've had a recession. Well, they discovered that rule and they had it named after them. But in this cycle, as everyone has learned what the Sahm rule is and has been paying attention to it, this person has become very prominent. And just in the last look, they're getting articles in the Financial Times right here. And look what she says. It's clear now who was right. And so this is a classically trained economist who used to work for the Federal Reserve, who went to college and got a degree for this stuff and was paid to know their shit. And they have so much hubris and they are missing the forest for the trees that they are now declaring victory. It's clear now who was right. They're saying that right here. They're saying that right here. With unemployment, job growth, following the traditional slowdown path on its way into recessions. We have 4 examples of recessions in most people's lifetimes that happened ahead of where we are now. And there's many others in the past that occurred with varying timelines that didn't have a yield curve inversion. That's just what we're using for our axis here. And we've got this economist, this now very well-known economist, who insists that victory is at hand. And when you read their comments and how they characterize the recovery, it's all but a foregone conclusion for them. So they're doing a victory lap while the data continues to unfold. And from my perspective, these people's entire timeline is wrong. Because if you think back to 2022, what characterized last year? It was the obsession by the market with recession, right? We on this channel didn't really start talking about it until November of last year. October, November, December of last year. That was when I built my data set that's powering this table here and all the tables that we're looking at for recession. I built that in Q4 of last year. That's when I came to a lot of my findings. They've developed since then, but that's when we started talking about it. But that was 6 or 9 months into a global, market-wide obsession with recession. Everyone thought it was going to happen. It didn't happen. We did not have one. And then everything started accelerating this year. The market went back up. Inflation started going back down. Growth remained resilient. And everyone who had that thesis, one by one, all gave up on it. One of the most prominent bears on Wall Street is a guy named Mike Wilson, who works for Morgan Stanley. All of last year and the first half of this year, the street was obsessed with his monthly notes, with his, expectation of where we were in the cycle. He capitulated. Mike Wilson, I don't have his note here to show to you guys because I'm not an institutional investor. I remember seeing it on Twitter. He capitulated on being a bear right here. It literally right here. He wrote a note, issued his mea culpa. He actually used the words mea culpa, said I was wrong about this cycle. I was too bearish, and I'm pulling back on my expectations. And he now has a higher price target. He capitulated literally right here, well, right before a multi-month downtrend, which just goes to show you how wrong-footed even the quote-unquote smart money can find themselves. But so we've got these economists. I'm using this person here. I don't mean to demonize Claudia Sahm. I don't actually know her at all. I don't interact with her that much, but she's been one of the more prominent voices, and she represents the academic class in the market. These are the academics. These are the PhD economists that give the Fed all of their backing and their research. They are folks of her ilk, and they are so overconfident in their ability to assess the economy that they're jumping forward into victory. And they're now declaring that everyone else needs to say how they were wrong and admit that the economy is going to be fine. You guys know my perspective. You know the perspective we're taking here. And there are certain other elements of the economy that just look very bad. Credit growth, right? This is the growth of the 4 different major components of credit. Overall bank loans, which is everything, business loans, consumer loans, and real estate loans. All of them on a 6-month annualized basis, slowing down sharply. If I zoom out so that you can see, so you can see what it normally looks like. I've shown this chart to audiences past, but we will look at it one more time. And let me fix the axis so you can see this just a little bit better. We're all the way down here on credit growth. And if you look back, if you were to pause this video and really analyze it, I've actually gone through it with a fine-tooth comb, and I've modeled all of the periods in and out of recession. And for us to have credit down here is quite anomalous outside of recessions, especially for it to be all sectors of credit, right? It's all 4 of these are down essentially, are at 2% or worse. And that has only happened in recessions or on the way into them. If we zoom in on that, this is just most recent part of it here. What is this? What is the blue one? Business loans. Look at that. It's flat. Like nothing is happening. Businesses are not creating more credit from the banks. Now, there are avenues for businesses to get loans, like private credit, but the banks aren't lending. They aren't creating loans for anyone. And consumer credit, which had been one of the more resilient components of this, real estate and consumer credit, those are both slowing down sharply. And just here in the last couple of months, consumer credit's gotten a lot weaker. Let me clear this axis range. Yeah, consumer credit has gotten a lot weaker, and it's almost flat. It's actually on a slower rate of change basis than overall bank loans and bank credit creation. So there's still a lot left to be resolved. And one thing that I think, I want to touch on the price charts here in just a moment, but I want to get through this line of thinking while I'm on it here. I think that there is a dynamic that is not being given the proper amount of respect in our current cycle. And I think that it's going to play a major role in the next 12 to 18 months. And I'll show you what I'm talking about. This. So I posted this yesterday. We talked about this a little bit in the last week's stream, and someone asked me to clarify this on today's video. So I'm going to do that. This is the federal funds rate going back to the great financial crisis right here, 2008. You see that? This was the Fed cuts in 2008. And then we had ZIRP, zero interest rate policy. That's what ZIRP means. And it started here at the end of the great financial crisis, and it took up the majority of a decade and a half, minus this, interruption here from 2015 to 2019 when they tried to normalize policy and quickly abandoned it. The thing that I think is being lost is that most of the debt that exists today was born in this box right here. And it's this box, I drew this intentionally. It stops right here at the beginning of Fed tightening. Because if we look at our charts and we look at rates of change, that was when credit growth started slowing down. The Fed started tightening right here. We had another month or two of the rate of change of business loans accelerating, but then everything started to decline in, July of August of 2022. Just a couple of months after my little box ends right here, somewhere right in here. And the Fed jacked rates up extremely quickly. If you look at the Fed funds rate, same chart, and you compare this cycle with the great financial crisis tightening, the tightening from 2004 to 2006, they covered less ground in more time. This was a 2-year tightening from summer 04 to summer 06, and they covered from 1% to 5.25%. This tightening cycle was 18 months, and it went 500 basis points. So we covered more ground in less time. Okay, you with me so far? So we have all this debt back here. Now, a key function of debt markets is refinancing. We have so much debt that a major piece of economic stimulus, of activity, of general consumption and movement of capital throughout the economy hinges upon the ability to refinance debts, right? To be able to lower financing costs, reduce debt burdens, and manage one's balance sheet. So we've got all these businesses and households that accumulated debts during the zero interest rate regime. And it accelerated a lot right here, right when COVID hit until the beginning of 2022, this window right here. Oh, sorry, that's an ugly color. Let me make this red so you can see this just a little better. This window right here had massive refinancing. Right? Everyone who owned a fucking house refinanced. Businesses did so. Massive amounts of debt were accumulated right here, right before the Fed started raising rates. And then they spent 18 months sending rates above the great financial crisis peak. We're above that. You can see that here. We're above that level in a shorter amount of time. Now, what are we going to talk about for the next year, right? We're expecting the Fed to cut rates. And if you look at market pricing of Fed cuts, which is over here, this is FedWatch. We've looked at this together. These blue boxes represent the most likely outcome according to market positioning for where the Fed funds rate will be at each of the next Fed meetings. That's how you read this table. And as of January expectations, they don't think that the Fed funds rate will change. This is where we are right now. We're at 525 to 550. Call it 5.5%. And the market expects that by March, we're likely to have the first 25 basis point cut. By May, we get another one. By June, we get another one. July, another one. September, another one. December, another one. So where the market thinks that by the end of next year, we will be at 400 basis points on Fed funds, 4%. So the market thinks that we're going to cut rates to the bottom of this blue box. The market thinks we're going to do this. That's what is currently priced in right here. That's optimistic. If you think about this distance, what is that? That's 125 basis points of cuts, right? That's a fourth of what they just did to tighten and fight inflation. And the market expects them to erase all of that next year just through pragmatic policy, just from the Fed going, inflation's coming down, growth remains resilient. We're going to cut slowly and try to gently ease off the tightening so that the economy can continue forward and we achieve the soft landing. And now they may pull that off. But I just want to illustrate the complexity of this setup. We're talking about debts and the cost of money, right? The cost of refinancing. So if the market expects this, and let's say we get it, let's say the market is correct and we get 125 basis points of cuts next year, but everything is still okay. We don't have a recession and the market's correct, then Fed funds is right here. All the debts are still down here in terms of where their interest rate is, right? So even if we have a Fed funds rate right here, everyone who owns a debt from back here is still paying more money to refinance. Their debt costs are still increasing so that the cuts from the Fed don't actually help them at all. Are you starting to understand this? So what the market actually needs is this. They need this right here. They need Fed funds. Let me get my drawing tool. They need Fed funds back down here into this area. That is the only place where you can start to see debtors easing off of their burdens, their financial burdens, actually lowering their borrowing costs. Because anything above this level right here is an increase in borrowing cost for anyone who took out a loan before March of 2022. Businesses, households, everyone. So the idea that Fed cuts are going to be stimulative is under extreme scrutiny here by this perspective. And for the Fed to actually cut this much, something very bad needs to happen, right? And then we're not talking about, reducing financing costs in an expansion and making things easy. We're talking about saving the economy from a deleveraging. Now, that's a different situation. But if we don't get a recession, if the bulls are correct, then what they are expecting, which is currently extremely aggressive, is nowhere near enough because of this gap right here, this 200 basis point gap, to just get to the ceiling of easing on financial costs for debtors. Debtors are everyone. Everyone has debt. Everything functions on debt. So is there any other information that backs up my perspective here? Why? Yes. Thank you for asking. So I've been talking about this a lot with you guys. I've been talking about it on Twitter also. Here's an article from Bloomberg just a week ago. Rate cut pivot can't come soon enough for debt-strapped companies. This is exactly what I've been talking about. Any business that has a loan that took out before 2022 is now going to be facing higher refinancing rates. There is a lot of financial tightening occurring. This is a guy who works at the U.S. Chamber of Commerce. Companies rated below investment grade, meaning they have a slightly lower credit rating, are particularly vulnerable, with their debt maturities having shortened remarkably during the rate hiking cycle to less than 5 years in the United States. Maturity meaning how long they have before their debts expire, and they have to roll them. They have to they have to take out new debts. Companies usually refinance before they reach maturity dates. They like to manage their debt burden in that way. Well, if you go down and you look at the average maturity of debt, corporate high yield debt maturity, it's falling. So that the average maturity of debt just in the last couple of years has fallen 2 years. It's fallen from above an average of 6 years to maturity down to just above 4. This is people piling on short duration debt with the hope that interest rates are lower before they have to roll it and they can get a lower cost of capital. They are white knuckle gripping their loans and praying to Christ that Papa Fed rescues them. But as we just talked about, what they think is going to happen is nowhere near what they need to have happen. So there's this massive article here on Bloomberg. I posted this. You can go find this on my feed from just a few days ago. Where I posted this whole article for you to read. And here's another piece of it. Actually, let's look at it. I highlighted it here. Looks a little better. Change in central bank rates in basis points. What the market expected. This is what the market thought would happen in 2023 in each of these jurisdictions to interest rates. Markets thought in the US we'd see a 66 basis point hike last year. The Eurozone thought they'd get 141 basis points. Remember, basis points, there's 100 basis points in a percent. So 141 bips, when someone says basis points, 141 bips is 1.41%. It's the same thing. So just put a decimal point right here. Put a decimal point right here. That's 0.66%. So anyways, last year, going into this year, remember, after a hiking cycle had already been taking place for 9 months, most developed markets expected mild amounts of cuts. Every single one of them, with the exception of Japan, was wrong to the upside. What actually happened was they got a lot more hikes than they thought they would get. The market was way wrong in every country. Now, what they think is going to happen in 2024 is massive cuts across the board, except in Japan. The market is now expecting triple digits of cuts in many jurisdictions. They are praying for a return to normal. It is the consensus. It is the global consensus that we're going to quote unquote return to normal on interest rates. And then we're going to get hundreds of basis points of cuts. But recall, friends, how far away this box is from this box, right? This is at the 4. This box is at the 2.5. This is another 150, call it really 200 basis points to get down into a safe area on lowering cost of capital. Well, none of these numbers are that big. None of these, and now this isn't all Fed funds. You know, these are all different jurisdictions. But no one's going to out-hawk the Fed. And everyone's assuming that we're going to get massive cuts just across the board. The same way they expected mild hikes across the board. They were wrong to the upside. Now they're expecting huge cuts. Could they again be wrong to the upside? It's worth asking yourself. And so I think what this sets up for is a really precarious policy trap, where the Fed is going to find it difficult to justify large amounts of interest rate cuts, because a lot of the forces that helped to drive inflation down this year can't be expected to continue at the same rate into next year, right? There's an element of disinflation that has already taken place. Things like falling used car prices, that they have fallen already, right? Gas prices. It's RB1. Gas prices, down huge, right? How much more can they really fall? Are they going to go down here and just hang out? Are gas prices going to go to $1.20 and just like hang out down here? Or have they put in the majority of the fall? That's disinflationary. Falling used car prices, that's disinflationary. But wage growth is still at 5%, right? Atlanta wage growth tracker. There's Atlanta Fed wage growth tracker. Let's look at it together. It's over 5%. Wages are over 5%. There's a thread from Bob. Where is it? There's a thread from Bob that I just saw the other day. Bob E Unlimited. It was about inflation. It was about inflation. Actually, I know how to find this thing. Give me 1 second here. I want to pull up a thread for you guys. Here we go. Oops. Oh. Dang it. I copied the note. I didn't copy the URL. Sorry. Hold on, guys. We're doing it live. We're doing it live. Okay. Here it is. I want to walk you through some of these charts because I could make these for you, but since Bob already did it and Bob is a Chad, we're just going to use his thread. Bob is making the point I'm making to you now. The point is that inflation getting durably, consistently below 2% so that the Fed can completely declare victory will be difficult in the current environment. Because what I just said about gas prices, right? That's on a monthly chart. Basically, since summer of last year, gas prices have just been structurally breaking down, and they recently broke down even more, right? He talks about wages. Let me find there's a couple of the charts in here. Here's a couple. He's talking about when the Fed cares about inflation getting durably back to target, not whether the report is printing there. If it doesn't stay there long term, then they can't declare victory, right? The move from 6 or 7% CPI last year to 3 or 4% now was driven by several big disinflationary impulses. One of those, motor fuel, right? I said gasoline prices, but motor fuel, same thing. Those prices have been falling. How many more months of this do they have to go? If this softens even back to zero, just to normalcy, that is an inflationary net impulse, right? That's another chart of gasoline prices. Then he says a similar dynamic exists in other major categories. Household durable goods, which is like large appliances and things of that nature. Those prices have been falling. But just look at the entire decade from the great financial crisis to COVID. They averaged 4 or 5% on an annualized basis. So if they just return back to something resembling normalcy, that is net inflationary. Used cars, same dynamic, been falling sharply for months. Are they going to come all the way back down to their pre-COVID levels, or have they already fallen quite a bit? If you look at services X shelter, it's important to look at that. It represents a different perspective of wages. So we just looked at that Atlanta Fed wage growth tracker. You can also look at the rate of change of average hourly earnings. That's something that's built into our recession modeling. But you can look at services less rent of shelter. And that excludes the shelter piece, which is kind of a weird assumptive calculation. But the rest of services is largely wages because the services sector is very labor intensive. That's their biggest input cost, and it's their biggest cost, period. Most services inflation is tied to incomes. So what is that doing? It's at a 5% rate, 4-5%, these blue and red lines. And so he has a few other charts in this thread. I'm not going to go through every one of them, but you get the point I'm trying to make. There are net inflationary, not meaning that we're going to go back to 9%, but things that helped pull down the year-over-year rate of change of inflation, those have largely run their course. And so the question then becomes, what does CPI look like over the next 6 months? What does it average over the next 6 months? And if you look, say what you want about core inflation and how broken it is. It does represent certain lagging components because the headline figure is heavily massaged to underreport itself so that they don't have to give such huge entitlement increases every year. They intentionally underreport CPI. But when you see the rate of change of multiple components inside of it, it tells a certain kind of picture that inflation is not just going to go all the way back down to 1% and stay there. Those dynamics aren't present in the pieces that make up the headline component. And, a major piece of that would be home prices. And even those, while they're coming down, they're still relatively resilient. And on an annualized rate of change basis, they're still growing 5, 6, 7%. So the setup does not favor huge amounts of Fed cuts. It favors small incremental cuts to try to gently lower the plane. But while they're performing these small incremental cuts, you've got a bunch of people, from this article, these businesses who are saying, holy shit, guys, we can't refinance. We really need help. And as I have been saying, 100 basis point cut to Fed funds won't get it done for this lot because of the zero bound starting point and the speed of hikes. Nothing but a chasmic reversal in policy would unleash the refinance channel that's usually a source of stimulus in an easing cycle. A soft landing Fed won't cut enough for them. They need hundreds of basis points. That will play a role over the next year. I don't know when. It's not like you can put it on the calendar, but expect to hear more about this, and remember who was telling you about it first. I'm going to take a sip of water. I'll catch up on the chat, and then we'll look at a few price charts together. In the chat, someone says, TX had a quote I'd like to find. If Powell threads this particular needle, he'll be the fucking man, or something to that effect. What I said, I think, and I mean this, if Powell pulls off the soft landing, if we don't have a recession, the economy stays resilient, labor stays positive, consumption is fine, inflation is defeated, and 2 years from now, we're right back into a blossoming, strong, stable economy, then Jerome Powell is the greatest Fed chair of all time. I think it's unequivocal. And that will upset a lot of people who are just blanket haters of central planning. And I get it. I'm not cheering for the Fed, right? Like, I don't give a shit about them personally, but I want the economy to do well because it's our lives, because it affects the whole world. And because those who can least afford it will be the ones most hurt by him fucking this up. But if he pulls it off, massive if, if he pulls this off, huge if, then he's the greatest Fed chair ever. And I think he'd like to be that. But I don't know that it's up to him. And that's a major disconnect between my perspective and the perspectives of a lot of people in the market. In my determination, it seems that there is a heavily overbought idea that the Fed is capable of staving off negative cyclical outcomes because they have a money printer, and that alone solves all problems. And I just stoutly disagree with that. Metal Ants, welcome to the memberships. Appreciate that. Picking up a channel membership. Brandon Hammond gifted another one. Thank you, brother. Very generous. Intuitive Guy says, thanks a lot for your hard work and for sharing all this for free for more than a year. My pleasure. I'm happy to share these things. Brandon Hammond says, we have to support TXMC even though he blocked me on Twitter. Did I block you, bro? I'll go check my blocks. Sometimes I'll get like a couple of bad replies, and then I'll just end up blocking like a handful of people, just because, like I'll see something, I'm like, oh, that's negative, I ain't got time for that, and I'll just like block them just because, I don't know, you just must have gotten caught up in the shuffle. He said I was being an asshole. Well, fair enough. I'm an asshole too. But I'll unblock you. I'll go check it out. I'm just catching up on the chat here. Still can't figure out Raoul Pal though. Yeah, Raoul Pal's a grifter. Can I answer your question since BCB is in Christmas mode? Where is your question, JB? I don't see it, my guy. Yeah, I'm just catching up on the chat here, everyone. They'll always sacrifice the currency before letting it all go to hell. That's true. But I think something that gets forgotten about when we talk about market and cyclical outcomes is that when they get to the point that they're sacrificing the currency, the negative outcome has already happened. Right? They don't just cut massively and print hugely without a crisis spurring it, right? Like, we run deficits and we spend on stupid things. But I mean, like, the massive stimulative impulses, the fiscal impulse we got in 2020 coupled with massive QE, like that happened because we were going head first into a catastrophic depression because they closed down the economy forcefully, the global economy, right? And so like that's why they stimulated. We still had a hugely negative outcome. And it was the biggest stimulus response ever. And they orchestrated it. Not only did they orchestrate it, they knew the day they did it. And we still got a negative 35% S&P in the month of March in 2020. So just think about that. And if we get to a point where it's too late, like if they think we're doing fine and then we get a bad news story about like a major shadow banking institution going under or some kind of key hedge fund and private credit blowing up, or, you know, some company has to lay off 20,000 workers or something and it creates a wave of other unemployment, like whatever the thing, I'm just making stuff up. If we get to the point that one of those happens and it creates secondary and third order effects, those things can't be stopped by the Fed just choosing to stimulate. I hope people get that. Like just because the Fed could come out, like if we get a deleveraging, you know, like when Lehman went down, right, in 2008, this is a long time ago, but like when Lehman collapsed in 2008 and it was like tipping over the refrigerator in a dingy old garage and you see all the cockroaches underneath and all the cockroaches start scurrying, by that point, it's already too late, right? Things have broken, are breaking, will break. And you can try to cushion the fall. You can try to whack-a-mole the problems as they arise, come up with a facility, do a selective bailout, give some stimulus to this bank, try to buy this one, nationalize this thing, whatever. Like you can try to play, you know, tornado kitchen with it. But at the end of the day, you've waited too long and you can't control the entire economy. And like I use this example all the time because I think it's such a good one. Not because these outcomes have to mirror each other, but because it's a good example of what can happen. Is the Fed cutting in September of 2007. They cut here. The market went to an all-time high. They kept cutting, right? 6 months later, let me draw on here. Hold on. First Fed cut, all-time high. Months later, Bear Stearns goes under. Many more months later, Lehman goes under. They're cutting the entire time. So people who have these dogmatic views, I'm not saying anyone in my chat is this way. This is mostly what I see on Twitter. And I'm sharing these things because I'm pushing back on ideas that I see that are commonly broadcast to the public that I just don't think mirror reality quite well, or that don't capture all the nuance of what actually goes on. And if you're going to talk about these things, you need to know this stuff, right? If you don't care, then you don't care. But if you're going to talk about these dynamics, then you need to have the whole picture. And the Fed cut back here, like September, August of 2007, right in here. New all-time high a month later. In February, hold on. The recession begins right here. If you ask the NBER, when did the recession of 2008 begin? Well, it's right here, sorry. December 2007. I was off by a pixel. It started right here, right? So we get Fed cuts, all-time high. Recession actually begins, though the NBER doesn't tell us until we're over here, right? They tell you like a year and a half later. And then in February of 2008, right in this period of time right here, as I told you guys last week, Ben Bernanke went to Congress and he said, no recession, everything's fine. But we were actually already in one. And then a month or two later, Bear Stearns collapsed. Like a month later. And then another 6 months later, Lehman Brothers collapsed. Fed cutting the whole time. Recession began before Bernanke told us everything was fine. So there are multiple points in a cycle where people think they know what's happening and they're dead wrong. They think it's the end and they're dead wrong. They think that everything's fine and they're wrong. They look around and go, oh, the last couple months haven't been so bad. We're doing okay. And they're still wrong. But if you look in other places, you look at the rates of change of the economy, you look at the credit markets, you look at the labor markets, all the pieces of it, not just non-farm payrolls, but as we do on this channel, you go look at job losers, job leavers, part-time for economic reasons, temporary workers, all that stuff. Those things tell you a story. Catching up on the chat. David Lashinsky with the dono, most underrated content creator. Thank you. Hey, much appreciated, David. That's very generous of you. Thank you so much. Bilbo, welcome to the memberships. Yes, Macro. Oh, Macro says, oh shit, I didn't know they cut that far in advance back then and it still went downhill. Yeah. The first Fed cut, it's a little weird here on the Fed funds chart, but officially the first cut was September of 2007. The recession began 3 months later. 2 months after the recession began, Bernanke went in front of Congress and said there's no recession. 1 month after that, Bear Stearns went down. 6 months after that, Lehman went down. And oh, by the way, the high of unemployment was way after the recession. The high of unemployment was like back here. Like well after. Let me show you. Unrate. Here it is. See where I circled? Basically there. These sequences matter a lot. They matter a lot for understanding how long this process takes and how easy it is to get convinced of a certain outcome before it has been decided. So when I see classically trained Fed economists like Claudia Sahm declaring victory and saying that everyone needs to admit that they're wrong, when we are right here. Oops, sorry, my drawing tools are failing me. We're right here. I struggle to find the words to encapsulate just how wrong I think they are. Now, I will be happy to see much of this data turn around over the next few months and go higher. It's possible. I can't rule it out. But I'm also very careful not to declare victory because there is no point to doing it now, except to just get clout, I guess. And so it makes me think that some of these economists are paid mouthpieces of the state. Because what would be the incentive otherwise? It's my understanding, this is Alessandro in chat says, it's my understanding that compared to the GFC, banks and regulations have changed quite a bit, and nowadays the Fed has better insight onto the health of the banking system. Well, they have better insight into the health of the commercial banking system. However, they don't have a lot of insight into shadow banking, into non-banking institutions and the lending that goes on there. There's a financial stability report that came out of the Fed, I think in May of this year, April or May, that you can read if you want, but it's really dry. But inside of there, they talk about private credit and how it has grown considerably, and they don't know nearly enough about it. And that's the same thing that happened with Lehman in 2008 with different products, different kinds of financial products. But Lehman had a bunch of interwoven leverage with a bunch of non-banking institutions, and it went much deeper and broader than the Fed had any idea about, than regulators had any idea about. And while they have done work to try to rein in a lot of that lending and a lot of those practices, what ended up happening is that lending just got pushed out of the commercial banking system. It wasn't stopped. It was just sent to other places. So now you have this massive network of non-banking institutions, hedge funds, private equity groups like Apollo and Blackstone and these others, And they provide lending to businesses and entities that is completely separate from traditional commercial bank lending. Private credit has exploded. It's like a $1.5 trillion industry now. And some of these articles that I've been reading about this stuff talk about private credit. And I think I actually posted, let me go, just a couple. Oh, this is someone asked the other day to drop the most iconic photo of you. So I dropped this. This is me, but it's not me. This is an AI photo. People are asking me. This is my face, but the rest of it's not me. Just some people had asked that. But what I wanted to do was find one of the threads that I posted the other day. Here we go. So Wall Street wants to let junk firms pay interest with more debt. So let me read just a bit of this. Wall Street banks are paving the way for deals to let cash-strapped, junk-rated borrowers pay their interest with even more debt as the higher borrowing costs start to bite. Investment banks like JP Morgan are attempting to bring something called payment-in-kind debt to the leveraged loan market, private credit markets. This is used to push back the maturities on debt and avoid refinancing at higher interest rates. But what it does is it raises borrowing costs just a couple years in the future for people who take that option when they are already taking that option because of high borrowing costs. A prolonged, tighter monetary policy regime poses an existential threat for some highly indebted firms. Default rates are expected to rise to 3.8% for European junk debt by September of next year. And this is part of the private credit market. I've been trying to read a lot about this. It's about $1.5 trillion now, and it is outside of commercial banking in a lot of ways. And the Fed doesn't have total insight into it. And a lot of businesses, we noted that credit growth had slowed down, right? Especially business loans. It's because a lot of businesses that need debt now, that need liquidity now, they're going to private credit. They're not going to the commercial banks because the commercial banks won't lend to them. But these private lenders will at different terms. And you're seeing a lot of that. But unfortunately, we can't track that with commercial bank loan rates and commercial bank loan sums. What could go wrong? Exactly, Alan. What the fuck could go wrong? We only have a giant $1.5 trillion opaque market where businesses are taking out loans to defer their interest costs and white knuckle gripping them, hoping to God that Daddy Fed bails them out. Literally 2 huge articles I've shared with you today about this exact topic. Deferring cash interest payments can give borrowers breathing room, but it doesn't come cheap. In the private credit realm, that's what we're talking about. While first lien loans can add an extra 25 to 100 basis points, the payment in kind option, the please don't make me pay my debt today, but give me a new debt today, those loans can command an additional 300 to 400 basis points. That's 3 or 4% on top of the cost today. This cycle is not over with. It's not over with because of this right here. It's not over with because of this right here. So the fact that the stock market, S&P is not at all-time highs, but sorry, DJI, the fact that DJI is now at all-time highs is awesome. It's awesome. It doesn't mean anything, right? What did we just talk about with the great financial crisis? First cut, all-time high, recession started. Like, doesn't mean anything. And so when people get mad at me for continually pointing out this data on Twitter, and increasingly, the reply guys are angry with me for not acknowledging that stocks are at all-time highs. Those people are idiots. They don't understand what they're asking me. because they haven't looked at the chart. Look at the price chart. Put the recessions on there. It's a free indicator. Look for my name. Type indicators. Type TXMC. Recessions will come up. Add it to your chart. Zoom the fuck out. And look at where the highs are. Look where the highs are. Look where the highs are. It doesn't mean anything for the recession call, for the conversation that we're having. It is a mouth breather deflection that is given from an emotional frame of mind. It is not analytically grounded. When we think about this on a secular basis, friends of mine who also follow Blockchain Backer, they know what I'm talking about right here, right? Let's put this on the chart. This is the outcome we have been waiting for this whole time. So far, nothing has encouraged me in the data itself. Nothing has encouraged me to abandon this thesis because it's playing out exactly as we thought it might. Not because we get every turn correct. That's not what I'm trying to say. I was surprised by the move up this year and how strong it was, and I wasn't sufficiently bullish on the stock market early in the year. I kept focusing on my data here with the perspective that by the end of the year, we were likely to be facing some troubles. We're at the end of the year, we're facing some troubles. None of that has changed. And all along, in the back of our minds has been the thought, what if the NASDAQ and the Dow Jones break into an all-time high, touch the 4.236 of a multi-decade expansion, and that's the end of it? What if they do literally what Bitcoin did? Is that possible? Yes, it's very possible because these two look quite similar. My buddy BCB, I think he showed this yesterday. He and I talk a lot, and it lines up so perfectly. Not for the percentages to be identical and the fractal to be identical, but the setup just aligns so well. And so if we're sitting here knowing that we've got these levels just above on the NASDAQ and the Dow, because we know the S&P already did it. We had Bitcoin do this thing just a couple of years ago, and it is a leading indicator of liquidity and the cycle broadly, in my opinion. It's one of them, right? It's one of the more volatile ways of determining where we are in the cycle. And then we've got the NASDAQ, the bigger version of tech, now putting in a similar looking build back up to its all-time high, with this hanging over top of it, with this looming in the background, with these debt problems, as we have described, hanging over our heads for the next 12 to 18 months, waiting to see how much cuts we get from the Fed. That is a heady setup. Holy shit. Like that is a meat grinder setup. And what's happening right now, right? We've got Bitcoin reaching up into its retracements. This is Bitcoin in blue right here. It's above the 0.5. It's headed towards the 618. And what's going on? Everyone in my replies is yelling at me that I'm an idiot. Why are you still talking about a recession? These things are impossible to model. You're wasting your time. You're clearly just doing this for clout. You were left behind by the market. All of your followers are going to get wrecked because you are telling them to stay in cash at the beginning of the next secular bull market. Like, these are literally things people say to me on an almost daily basis. And it has increased fivefold since September. Then you look around. Bloomberg says we're about to have a new crypto supercycle and Bitcoin's going to 500,000. Just on Friday, the SPY ETF, which is the S&P, had its historic all-time inflows in a single day. Everybody's long the stock market. Everybody is giga-fucking long. Bonds are betting on a massive interest rate cut. I showed you them earlier. This isn't, people think this is the recession, like the bonds are getting bid heavy just because of the recession. I take a different tack. I think this is a fixation on Fed cuts. This is the return to normal trade because everybody expects it around the globe. And as soon as the news came out today that UK inflation was softer than expected, what happened? What happened in that moment? S&P ripped. Dollar plummeted. Now it's recovered some, but it sold off sharply. The euro or the pound also sold off. Everyone's just assuming rates have to come down. Everything's going to soften. Everybody's going to ease. We're going to go back to normal. Let's fucking do this. And it is a much more complicated setup than that. Technologist, welcome to the channel. Thank you for the membership. And the thing to consider is certain aspects of the market have literally put in their 2024 projected gains already. The Russell 2000 is up 25% in like 6 weeks. It's basically put in all of its assumed gains into next year in the couple of months to end this year. We're not even to New Year's yet. So the bar for outperformance next year is astronomical for us to surmount. Maybe this keeps going higher for a bit. I'm not calling for this to just roll over here or anything like that. I'm just suggesting that the risk reward on this market in particular here seems quite low, particularly from this perspective here of this being a high on an unclosed candle. If this closes below this level on a weekly basis, if we get some big fat candle like this, maybe like this, and we get a couple of wicks. My wicks are terrible, but you get the idea. We sweep the high and then we close below it here. That's pretty ugly, and I would expect us to come back down, into this region here over the next few weeks, next month or two, because we're at range highs and we've blasted to it on one of the biggest rallies the Russell has seen in a very long time. Home builders, they did the same thing. Home builder stocks, look at that. All-time high. Why is that? Is it because the 30-year came down? Maybe. Look at that reversal. Pinpoint. 30-year rates falling hard. What's the result? Home builders, all-time highs. But Home Ownership Affordability Monitor from the Atlanta Fed. Home ownership affordability is the lowest it has been since before the Great Financial Crisis. Look at this. This is where we are. Look at that. This is affordability. This is the threshold of what the Atlanta Fed determines homes to be affordable at. This is the, average of the last decade and a half. And we're down here. Sure. Home builders to all-time highs. Yeah, sure. Okay. Oops. So, kind of a whirlwind day here. Bouncing around. Let's see what the actual market performance of the day is, though it's less important to me right in this moment. Risk on. That's a risk on day, mildly so. So, if you guys have any questions for me, things you wanted me to cover today, make sure you're putting them in the chat now, because we'll probably wrap up here in the next 10 minutes or so. I'm not going to go for an hour and a half. I amazingly got through my spiel, and it's 12:05. Incredible. That's so rare. Usually it takes me an hour and a half just to stop talking. I hear Clear says, you and BCB are the greatest professors I've ever had. That actually means a lot to me to hear that. It really does. Blockchain Backer is one of my very good friends. We talk all the time. And I've learned a lot from him about market psychology, about the undulations of humans in cycles, and just kind of what to expect at major inflection points and things to look for. He's been a great sounding board for that. I see my buddy Trader XO in the chat. XO is another good buddy of mine. We talk quite a bit. I've learned a lot from him as well. Make sure you follow those two guys and listen to the things that they say, because they're a couple of the best ones in the space. Oscar Hernandez became a member of the channel. Welcome, my brother. Stephen Edinburgh gifted 5 memberships. Very generous. This is amazing, guys. I see BCB just showed up in the chat. What's up, Blockchain Backer? Hope you had a good space. Just been kind of wrapping things up here. Did my spiel for the last hour. Talked a bit about the precarious situation with interest rates. We talked about this graph here. For those of you just now getting in here, maybe you were listening to BCB on Twitter, maybe you didn't join the stream till late. This was something we spent a good chunk of the first half of the stream on. It's talking about this dynamic, about how the majority of existing debts were born in the zero interest rate regime that lasted for over a decade, the better part of a decade and a half. And we raised rates so quickly and so hard that almost no one has refinanced at the new cost of money. Almost no one. Some have. But the broad edifice of debt still exists from down here. The economy is still functioning at 0 to 2.5% Fed funds rate, even though we're at 5.5% today. It's part of the reason why there is an illusion about how strong the economy is, even though when you look at things like credit growth, as we've explored quite a bit on here, where's my credit growth chart? You can see they're slowing down a lot in the last year and a half, and they're almost flat on a couple of measures. So we've got the Fed, they jacked rates up really hard. Everyone's still holding down here. No one refinanced on this move up. This blue box is the very optimistic expectation of market cuts for next year. This red box is how much the Fed actually needs to cut just to get us back to a place where anyone who needs to refinance has a similar or better debt cost, service cost, interest rate. Because every debt that is held now is significantly below market rates. What is the incentive to refinance if you will be paying more, other than the fear of default? That's going to be the only reason these people refi, simply to avoid default. And that will cut into margins, that will cut into disposable income, that will affect labor strength, that will affect wage strength. This is a real problem because of how fast this line moved and how little how far it went and how little refinancing occurred during this window. We are a massively over-indebted economy. We must roll our debts. And when you read these articles, Wall Street letting junk firms pay interest with more debt, the Ponzi-nomics are running at maximum velocity. And people like Claudia Sahm, classically trained Fed economists, are demanding that we all declare victory. I think I replied to her yesterday. I saw something she said last night and I replied to her. I'm going to find it real quick and I'll show you guys. Here she is. When will economists stop taking victory laps while demanding those who got something wrong prostrate themselves in defeat? Literally what I said, right? Claudia Sahm, I'm not taking a victory lap. Right, she's not taking a victory lap, but what were we just looking at? We were just looking at that chart from the Financial Times article, where it's literally her quote saying it's time for people to admit they were wrong. I'm not doing a victory lap. I just want to make sure that we learn the real lessons. Getting it right will matter when someday we have the recession, not next year. We're not doing it for our egos. This is absolutely for your ego. This is absolute hubris right here, to be declaring victory now when there are still multiple examples of recessions in front of us. This is the most chaotic meat grinder setup for the end of a cycle that I have ever modeled. Of all of the eras past, this is the most shit show-esque. And I don't think it's appreciated. It doesn't mean it's Great Depression. It doesn't mean the market's going to fall 70% in 2 months or something like that. It just means that people declaring victory, people speaking in absolutes about positive outcomes, are talking their book. They're talking their ego, and they're giving you what they hope will happen. Defaults are up. Bankruptcies are up. Delinquencies are up. Recall the last couple of streams when we looked at delinquency rates. Credit growth has been choked off. Private credit has exploded. You got businesses taking out debt to pay debt. What a mess. Good Lord. My name plus some donated and said, I heard Lynn and others talk about an emerging market style recession for the U.S. as a possibility where stocks go up and bond yields rip. Do you think that this is possible? I mean, sure, certainly anything is possible, and I have a lot of respect for Lynn Alden. She's very intelligent, and I've learned quite a bit from her over the years. I think there's probably a big difference with an emerging market that has a recession and stimulates and creates inflation with a currency that isn't the global reserve. I don't know that those dynamics play the same way here. I think it would be quite different. We'll just have to see. It's really hard to give like a specific answer on that because we've never really seen that before. The way that this is setting up is not the 1970s. It is not the 70s part 2. This is not a repeat of the Paul Volcker era. We don't need a Paul Volcker part 2. That is the wrong prescription. Gas got turned up. Yeah. Human behavior never changes. It literally doesn't. So one of my favorite things to do is read old financial history, market history. And there's this book that I absolutely love called A History of American Currency. You can look for this book. It's on the Mises website. A History of American Currency by William Sumner. This guy lived in the 1800s and he wrote multiple books. He has a book about the banking system. This book there's a free copy. You can buy a hard copy if you want. I bought a hard copy, but you can just get the PDF. It's free. And you can read this book. And if you are interested in financial history, you're interested in American monetary history, specifically American, but you also want to understand how bubbles have formed in the past and the different lessons that were learned from them, and how things tend to fucking happen over and over and over and over and over. This is a great starting place. It is plain language. Some of it is quite dry because it was written 150 years ago. So keep that in mind. But the stories in there are amazing. They're so cool. I love it. If you look at my physical copy, there are so many highlights and underlines and earmarked pages and stuff. It's wild. Like, I loved this book. It is free. Do yourself a favor, right? Let me see if I can find something from early on in the book. Long Island. Oh, wow. It's probably going to struggle to search on this, huh? There was a quote I wanted to find about Long Island Sound. Let me see if it finds it for you. Yeah. This is just one little example, right? This is about wampum, which was a type of currency used by Native American tribes in the northeast part of the U.S. when settlers first arrived here, right? When exploring parties penetrated to Long Island Sound, they found along its coasts tribes of Indians far more civilized than those who had been met farther north. The cause or indication of their superiority was that they had a circulating medium. This consisted of beads of two kinds, one white, made of a periwinkle shell, and one black. The beads were rubbed down and polished and used as ornaments, arranged into strings and belts of jewelry, being objects of real beauty when colors were combined. The beads and belts were used by the Indians themselves as money and were real money. The money was called wampum peg or wampum. The colonists began to use it first for exchanges with the Indians and then amongst themselves. This is not that different from when a nation takes up a new trading partner, and for a while they hold each other's currencies because it makes it easier for them to deal with one another, right? This is how monies are adopted and form, through expediency. The colonists began to use this wampum for exchanges with the Indians. It was first made legal tender only in Massachusetts. I don't know what this is, some exchange rate. It was first made legal tender only in Massachusetts, but by custom, it became the prevailing currency. The white man also proved his superiority by counterfeiting it. That line right there. Man found a good money. They started to conduct trade with it and developed a robust economy. They even declared it legal tender for a period of time. And then greed set in. And even though they had a perfectly suitable currency and trade was brisk, greed overtook certain actors and they thought fit to counterfeit this money. And as a result, they depreciated its value. Like, debasement happens a lot, right? It's the story of the Roman failure of the Roman Empire. Debasement of the currency over centuries was one of the major reasons for it. And this is just one tiny little story on page 4 of this book that describes how that's just one little thing. And if you go read a book about Chinese history, there's a book called On Chinese Currency that was written around the same time here. And it was about ancient China, like 1,000 years ago. And there are 100 stories like this. The counterfeiting of money, the destruction of an economy, all driven by human greed. We do these things over and over again. We had credit bubbles in the American colonies before the Revolutionary War. They didn't have enough money. There's a lot of those stories in this book. Highly recommend you check it out. And if anyone ever wants me to condense some of my favorite passages down, and maybe we just do a video where we just kind of go through some of those and talk about them, I would be happy to do that. I just haven't yet because I don't know what the appetite is from my audience as a whole. Might just be a handful of you that care about this kind of thing. But this is how I learn. This is one of the biggest things that's helped me to learn in the last couple of years. Not just this book, but this effort to learn about the history of money, specifically the last 400 years, but as far back as I can go. There are 224 of you following me right now watching this stream, and the number of likes has a 1 on the front of it. I can't see the number because it's squished on my screen, but that means there are at least 25 of you who have not hit the like button, and perhaps a handful of you aren't even subscribed to my channel. Please do me the courtesy of doing those 2 things. Hitting the like button, that's the minimum involvement for you. If you could just do that, that is a huge support for this channel by being here and hitting that little thumbs up button. But if you enjoy the content, you want to find out when I go live, and you want to be here at the beginning of the stream next week and all the streams to come, make sure you subscribe and turn on that bell notification. All right. That's the book. I will put the link in the chat right now. If you want to download the PDF, have at it. You can also buy a copy on Amazon for like $20. The market is ripping. This is the setup. I didn't even mention what was at the bottom of my screen here, but we'll just leave that alone. We'll get into that next time. This is the setup. This is the setup we have been watching for all year. We are now there. The thing to watch over the coming weeks is to see how this forms up here. To see if, in any way at all, it resembles this move from Bitcoin. It could. That's also the same kind of fractal that Ethereum made on its retrace in 2018. So if we get one of these push up, pull back, final little leg, and then boom, that's what BTC did at the top. That's what Ethereum did at the retrace. Those things would have me quite concerned, particularly if none of the economic data has turned higher for the better by then. So with that, I will let you guys go today. I really appreciate everyone being here. We had about 230 concurrent viewers at one point, which is, I think, one of the highest we've had. I'd really like to get that number up, but we'll just keep working at it over time. Next week is Christmas. Christmas is in 5 days. So we'll do another stream. I'm going to be out of town these 2 days. So I think maybe next Thursday or Friday, 28th or 29th, is when we'll do the next stream. So until then, take care of yourselves. Have a great Christmas. My kid is out of school today. Excuse me, I got the hiccups. This happens every time I stream. I get the hiccups. My kid's out of school as of today, so I've got a little no-neck monster running around my house. We will talk between Christmas and New Year's. I will do a stream. So this is not sayonara until 2024. We'll chat in about 8 or 9 days from now. I'll think about how to do the monetary history stream. Maybe it's the one we do at the end. Maybe we do it next week, or maybe we put it off for a couple more weeks and let me get my thoughts together. I want to do a good job of it for you. I don't want to just kind of meander around. I want to have thoughts in place. I want to have things to read for you because I have a million things that I've kept notes on. And I just, I want to be able to share them with you guys just to give you an idea of how much I have. Let me show you. So I have this thing called Standard Notes. Great app, just encrypted private note keeping. And I've got a bunch of different sections in here. I don't know if my buddy Trader XO is still watching, but I even have a section in here called XO where I just write down things that he's said on his streams and to me personally that I wanted to remember about markets, about trading. I have a section for Trader SZ. I have a section for reading Zoltan Pozar's writing. I have a section for the book Manias, Panics, and Crashes. And I have a section for A History of American Currency. And all I did was I wrote down all the quotes that I like. Some of them are bolded. I have a bunch of them. I do this a lot. I read a book, I take a bunch of notes, and then I go and I transcribe those notes into here, and I keep them for later. And I just go kind of scroll through them sometimes. And I find a lot of really awesome things that like, holy shit, that sounds like it could be happening today. Like, here's a great example of Gresham's law about how if you have multiple kinds of money in a market for people to use, they will hoard the good money and they will spend the shitty money. They will spend the weakest of all the monies. It's one of the reasons why I struggle to see a future economy where people freely spend away their Bitcoin rather than save in it and transfer it into some other currency to conduct commerce with, because it is so much harder of a money than things like fiat. When all other products were made legal tender, no one would pay debts in specie. Specie is precious metal. That's gold and silver. When all other products were made legal tender, no one would pay debts in specie. It was hoarded. A barter currency is also the most rapid of all currencies in its depreciation. If a cow will pay taxes, the leanest cow will be given. If corn will pay a debt, the corn which is of the poorest quality or damaged to a certain extent will be given. If a large number of commodities are made legal tender, the poorest quality of the commodity, which may be cheapest at the time of payment, will be given. The more barter currency was used, quote, because money was scarce, end quote, the scarcer the real money became. Prices rose to fit the worst form of payment which the seller might expect. So if you have multiple forms of money and everyone insists on paying you in the shittiest of all of the monies at all times, prices necessarily rise to capture that premium. Interesting things to learn when you read about monetary history. Just little stuff. Tons of little cool little quotes. Anyway, that's it. Love you guys. You've now seen the extent of my autism. We'll talk about some of this stuff a little bit later on, okay? Take care of yourselves. Take care of your friends and families. I hope you have a wonderful Christmas weekend. We will talk near the end of next week when I get back in town. Thank you, everyone. Thanks for the new memberships in the chat today. Thanks for everyone who showed up early. I'll talk to you guys next week. Cheers, everyone.